Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is May 6, 2018 edition of Market Outlook. Okay, so first thing, let's cover the key indices. You've got some significant improvement this week in terms of price action and where the market's actually sitting. So look, the QQQs, with the help of Apple, actually cleared its 50-day moving average, and that's the first time in several weeks. Now, the last time we did it, we abruptly failed, so we definitely want to keep track of that. Now, in terms of our real motion indicators, you can see we're sitting above our baseline and still under a little bit of pressure. So with some improvement in price here, this could start moving out above the 200 and the 50-day of real motion. What's interesting is net IWM is looking rather strong. It's the furthest away from the 50-day moving average after Friday's close, and momentum is looking better as well. Now, the other two indices tested over the last couple of days the key 200-day moving average and bounced off of it. So it looks like this whole sideways action across the board in the key indices is going to resolve to the upside, assuming we can confirm. You had pretty light volume test. I'll get into that in a moment overall. So that's the picture on the daily charts. Let's move to the weekly charts. So in essence here, let's see if the weekly indicators and chart patterns are consistent across the board. So we're highlighting IWM because there's definitely a change of the guard here where IWM is picking up some strength. So one of the things you can note here is on our real motion indicators, IWM is trading above its 50-week of real motion, which is also above the 200. So that is in a bullish phase. Now, in terms of the other indices, none of them are trading above its 50-week of real motion. Close in terms of the Dow, the QQQs sitting beneath the 50-week but above the 200. So momentum definitely looking more iffy on the Qs, the Dow, and the S&P. And in fact, you can see here on a longer term basis, a weekly basis, the S&P, even with Friday's action, looking much weaker relative to IWM. So at the moment, both on a daily and a weekly basis, the key focus here and the takeaway is IWM. Now, what I want to do is just head back to the IWM chart, and you can see we're now clearing about a week and a half of action and that 50-day moving average. So if we close above the 50-day moving average on Monday, that will be a confirmation of the phase change. That is positive. So there's your setup at the moment, and of course the key point here to watch on the downside are closes under the 200-day moving average. And in fact, if anything, I'd be watching even on an intraday basis that 200-day moving average if you have the time, because the way this market is acting, it could easily explode to the upside after this consolidation pattern. And also, if for some reason we get news or price action that follows through here to the downside, we want to be aware of that, because there could be a flash move to the downside that could be violent as well. So we're going to keep an eye on this very, very closely. Okay, moving on, taking a look at some risk on, risk off intermarket relationships. The S&P versus utilities has been under pressure, and the S&P has been weak relative to utilities, not a good sign. Of course, utilities is more of a risk off type of play, going for the safety of consistent earnings and dividends. So here you can see our relationship here, our the value of the S&P versus XLU. We're still sitting under both key measures. The black line being the monthly relationship, and the blue line here more of a 6 month. And again, the S&P definitely still weaker, although it did improve on Friday. So the situation in this particular indicator is definitely favoring risk off. However, on a more positive note, the other four key risk on, risk off indicators are showing a different story. So, in terms of stocks versus bonds, even with the bounce off the lows, the S&P still outperforming both on a 6 month and on a monthly basis. That is definitely a positive. Now, in terms of risky high yield debt versus bonds, you've got a similar scenario where high yield debt still outperforming relative to the safety of U.S. Treasuries. That is also a positive. The next thing is, with the short-term pressure on gold, the failure at around the 129 level definitely flipped this relationship positive towards stocks in terms of its monthly. It's on a 6 month basis, even though the S&P has been improving over the last couple of weeks, on a longer term basis, it's still tentative and actually favoring gold. But net, the way I look at this is S&P versus gold, still a overall positive. And basically, on the inflation front, wood versus gold, basically still favoring inflationary environment over sort of political instability. This is a good measure of that. And even though it sort of flipped to neutral or slightly negative on a short-term basis, overall on a longer term basis here, 6 months, you can see that wood is definitely outperforming gold. That's indicating good economic expansion and overall improving economic conditions. Again, a positive. So to reiterate here, you sort of got three tests of the 200-day moving average on the S&P. If we can take out the 50-day following breakouts in already in IWM and in the Qs, that would definitely put this in a upward trajectory. Now, the one piece of news that's not so good is that volume analysis based on the last 2 weeks of market action is not confirming any accumulation days or even just flat days. So you can see overall here, across four indices, we only have 2 accumulation days. So volume is definitely light. Institutions not running in here at the moment. Hopefully, if we start moving above that 50-day moving average, we're going to see some more accumulation days. But you can take a look and just see distribution. We've got 13 distribution days across the four indices versus 2 accumulation days. That is definitely not a positive and suspect. Now, net year to date, you can see pretty mixed bag. The core indices, the S&P, probably the best benchmark overall, still flat to slightly down on the year, with the big cap stocks under the most pressure. And of course, NASDQ up very strong. The earnings of Apple, Facebook definitely helped here, and of course Amazon. So there you have it. Overall, we've got a scenario where we're looking for volume confirmation on that technical improvement in the market. Now let's take a look at how sectors are acting. And one of the things you can note here is that retail moved up nicely on Friday. However, and it's also in a bullish phase. So retail and semiconductors actually acting well. So look, you can see on a 5-day basis, semis and technology leading the market up. So growth stocks, technology stocks still in the saddle. That's actually a really positive sign that we actually moved up this week, way outperforming the market. We like to see the speculative sectors leading the market on rallies. So that is a positive sign. However, taking a look at what's happening in terms of the number of sectors up over the last 6 months versus down, we actually got a degradation in that, because what happened is XLI, industrial stocks, the Dow, did not do well and actually moved negative over the last 6 months, just marginally. So that kicked another key sector to a negative territory, looking out a little bit longer term. So right now, sector participation definitely looking a bit iffy. However, on the positive side, the speculative technology and led by semiconductors, those sectors doing well, they're speculative. So you've got a definite mixed bag. Okay, finally, let's take a look at market hotspots. And as you can see, the other thing that is noteworthy in terms of the inflationary front, the takeaway here is XME, right here, moved into a bullish phase. Also, the other thing that is noteworthy is certainly on the inflationary front, impacting U.S. consumers, but also indicating strength in the global economy, maybe some tentative pressure showing up here because of the situation with Iran and oil. But nonetheless, over the last 6 months, you can see oil is up 33% coming off of those lows. That's pretty important. So the takeaway here is metal and metal mining, which is really mostly base metals, inflationary pressure, same thing with oil. So there you have it. Now, in terms of volatility, we got hit pretty good this week. VXX long volatility down 3%, not surprising with the day that we had on Friday in the market. That was a nice bounce off the lows. So at the moment, we're in a warning phase and pretty close to breaking down under the 200-day moving average in VXX. If we break through that, that would definitely confirm the move to the upside. Now, on the flip side, a move back into a bullish phase would indicate renewed pressure. So really, that's the overall synopsis here and in the markets. And the key feature is smaller caps, IWM leading U.S. equities up. Sectors definitely sort of a mixed bag, and volume needs to come in here to the upside. And with the close that we had on Friday, basically on the cusp of breaking out back over key moving averages, both on the daily charts and holding nicely on the weeklies, we could get a decent pop here. And the key point to watch, of course, is the 200-day moving average, which has been acting as support, and it's been now tested for the third time. So we'll see if we have the goods to get moving through there. All right, that's it for now. Hope this helps. See you next week, and good luck with your trading.